We might be the index boys, but when it comes to fixed income, index investing may not be the best strategy. We're joined by an expert from one of the world's biggest fixed income players to understand how we can best take advantage of the opportunities that are arising in bonds and fixed income. Welcome to Equity Mates Investing, a podcast where we explore what's possible in the world of investing. If you've just joined us for the very first time, a huge welcome to our community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. Bonds and fixed income. That is what we are talking today. They used to be the reserve of those with decent bank balances. Yeah, technical term, shitload of cash. But I think the really exciting thing for people like you and I, everyday punters, is this whole world is becoming more accessible. Yeah. And so 8 years ago, we started Equity Mates with the intention for us to learn about the world of the share market and equities. And it feels like we're really on the start of a whole new learning curve with some of these new asset classes that are becoming more accessible. We've spoken a little about private equity and how that's becoming more accessible, but bonds and fixed income is certainly in that category of more and more opportunities arising every day. And as everyday investors, we get to get our heads around it, figure out where the opportunities are, figure out who the best managers are, and how we can make some money in this space.
Well, speaking of managers, Ren, today we are joined by Executive Vice President and Head of Australian Portfolio Management at Pimco, Adam Bowe. Pimco is one of the world's largest fixed income players, so they certainly know what they're talking about. And they have 4 ASX-listed ETFs that give access to some of their strategies that, as you said, us punters can now use to get access where we used to not be able to get before.
Yeah, I mean, the Active ETF has really been one of the key ways that this asset class has become more accessible. And Pimco have listed 4 active ETFs here in Australia. So I'll rip them off quickly so you're aware of them. There's the Australian Bond Active ETF, PAUS, the Global Bond Active ETF, PGBF, the Global Credit Active ETF, PCRD, and then the Diversified Fixed Interest Active ETF, PDFI. Now, I don't think we need to unpack the difference between all of those because we ask Adam that question, and he's certainly more qualified to answer it than we are. But I think it is exciting that this asset class is coming to market. Yeah. And I think one of the biggest things we hear from the Equity Mates community is the dream for passive income. Yeah. The dream to live off your investments, or at least, not work as hard and have your investments carry some of the weight. And I think Australians have traditionally turned to dividends for that. And it's great that there are now other income producing asset classes that offer other avenues to income.
Absolutely. So a massive thank you goes to Pimco for supporting this episode. Without the support of all of our advertising partners, we wouldn't be able to keep all of the content here at Equity Mates free. So thank you to Pimco. But Ren, without further ado, let's jump into it with Adam. Well, Adam, welcome to Equity Mates.
Thanks for having me.
So we have interviewed a lot of equity managers over the years. I think we're verging on close to 500 or something now over the last 8 years.
Still don't know how to invest.
Still don't know how to invest. So I think a lot of people in the Equity Mates community can sort of relate to and understand what they do sort of day in, day out. But we're nowhere near that many when it comes to bond managers. So to kick off, how is your day today different to many of the equities managers that we've spoken to?
Good question. I must admit, I scratched my head getting invited onto the Equity Mates podcast. But as bond managers, like equity managers, but we're investing in bonds, which are just tradable debt instruments. So the easiest way to think about it is think of a company that needs to raise capital. They can issue shares or equity, or they can borrow money. They can either go to a bank and do that. The bank lends them money and that loan stays on their balance sheet until it's repaid, or they can go to the capital markets and issue bonds, which is just the same thing except tradable format. And bond prices change every day like equity prices. The main things that move bond prices around are interest rates, and then just how the credit qualities of the underlying borrower is evolving. So like equity managers, we're trying to buy bonds that are appreciating in value and not own the ones that are depreciating in value. And a lot of the day-to-day is very similar. What's different about bonds is, we're higher up the capital structure, so you get paid before equity guys get paid. And probably the biggest difference is just the size and diversity of the universe, which can get a little complicated for people who aren't familiar with it. So, I mean, just as a guide, the global bond market dwarfs the global equity market in size, and instead of having, an ASX 200 or 500 or S&P 500 or even the MSCI World Index, which I think has a bit over 1,000 different shares in it, the equivalent in the bond market, the global aggregate index, has about 30,000 instruments. So a company can issue, one equity. You might have a corporate issues, shares, but they might have 20 different bonds of different maturities and different currencies. Some are secured, some are unsecured. So certainly advantage having a big global company with a kind of on-the-ground resources and depth of analytics capabilities to be able to kind of uncover all the interesting investments. Yeah.
Well, Adam, if you found it strange coming on Equity Mates, maybe we'll have to pitch you our idea for a sister podcast, Fixed Interest Friends.
I'll be back.
But look, I think, touching on scale, like Pimco is one of the largest fixed income managers in the world. Yeah. If anyone has scale, it's you guys.
Yeah.
Would love to understand, I guess, your investment process, using that scale and that depth of resource, but just also just day to day, what you and the team are doing.
Yeah. So our head office is in California, but we're a very global and globally integrated firm. We've got 7 trade floors around the world, many other global offices servicing clients. So it's a very globally integrated business and a globally integrated investment process. So all portfolio managers like myself are on the same risk systems. We participate in the same investment process. We utilize the same execution platform that follows the sun around the world. So a very integrated global model. 4 times a year, the investment professionals get together in head office in Newport Beach in California, and really that kind of sets the formal framework of our process. We start with a clean sheet of paper, look at what we got wrong, what we got right. And the process starts kind of macro and top down. We look at kind of our expectations for growth and inflation around the world, because that's going to drive monetary policy and interest rates. But then the bulk of the time is spent very kind of bottoms up and micro. Portfolios are built bond by bond rather than kind of top down. And so we spend the rest of the time with every kind of trading team and specialty desk around the world, kind of presenting and debating on how the firm should be invested in their particular area of expertise. So we come away from those quarterly investment forums with a Pimco view of the world and kind of the opportunities that we think we should be investing our client assets in. And then portfolios like myself go back to our local markets and utilize that kind of global expertise and platform to construct and optimize client bond portfolios. Yeah, that's been the case. It's been the investment process for 50 years since Bill Gross founded the firm in the 70s, and we tweak it every quarter and try and improve it, but been very consistent for 50 years.
When you say that top-down and bottom-up approach, I think a lot of people will intuitively understand that top-down approach. If the RBA is going to raise rates, then the face value of already issued bonds will go down, so the yields kind of match up.
Yep.
The bottom-up side is interesting. I haven't heard as much from fixed income managers about that.
Yeah.
When you're going bottom-up, are you going like company by company, so you're looking at Commonwealth Bank as an entity, or are you literally going bond by bond and you're saying like CBA 2026 versus CBA 2028? Here's
great question, and it's both. It's both. I always remember back when Bill was with the firm. We have to go to bottom up and bond by bond, because we could have the best macro forecast on the planet, but as he always used to remind us, I can't invest in GDP futures. I've got to buy bonds. So what am I buying? And so we do have to go very micro and bond by bond. So in the example you gave with CBA, they might issue 26s or 32s, or could be in Aussie dollars or euros or US. They issue senior bonds, secured bonds, unsecured. They issue subordinated debt. And so really when we step back, we start at that macro level and get a sense for where kind of growth, inflation, and particularly interest rates are going, and then how companies are going to be navigating that macro environment. And then we try and break that down into kind of the 5 key risk factors that drive bond returns, being interest rates, then the shape of the yield curve, so not just interest rates at the 10-year point, but right across the yield curve. Credit fundamentals, do we like corporate credit? Do we like structured credit? Do we like financials? Do we like non-financials? All the way down to currency views and then volatility, because some bonds have optionality in them if they're callable, for example. So we kind of look across those 5 risk factors, but then kind of start with portfolio construction bond by bond. So if we do like credit fundamentals, do we like them in corporates or financials? Which banking system has the best fundamentals? Which companies are doing best within that? And then we're looking at their whole kind of universe of bonds that they issue, which ones look most attractive for our clients.
You can start to see the added complexity in the market compared to just analysing one CBA ordinary share.
Yeah, that's right. And it kind of emphasises just I've kind of been doing this for nearly 25 years, and I've worked at local companies and global companies, and I can't kind of emphasise enough just the advantage of having a kind of a big global resource firm that has kind of feet on the ground in all these areas that you can kind of leverage off being a portfolio manager. Yeah.
So, Adam, a lot of investors, including Alec and myself, have adopted a passive approach as part of our core portfolios.
Well, I think we could say in the equity world, the active versus passive discussion is largely settled. There are some active managers that outperform, but they often struggle.
Yes. The stats show otherwise. So why does active management matter more in fixed income? And I guess, is a passive approach feasible, or what are the risks if you go down that path?
Yeah, so I think you started the right area, which is kind of what does history suggest? Is active or passive better? And as you mentioned, equity markets, it's hard to make a case that the average equity portfolio manager outperforms. The data suggests they don't. But if you look at the same set of data for fixed income managers, the average fixed income manager does outperform after fees. So why are bonds different in the active versus passive debate? And I think there are a few, there's some really important reasons and risks about passive investing in fixed income. First of all, most fixed income indices, like equity indices, are market value based. That's great if you're an equity investor, but it's not great if you're a debt investor. The most highly levered indebted entities end up being the biggest part of your index, which is probably not the ones you want the most exposure to. And then in terms of why there's kind of a persistence in outperformance of fixed income managers, I think there's a bunch of reasons. There's things like bonds aren't perpetuities, they're not equities. So the indices change every month. New bonds mature, new ones are issued. When corporates have to issue a new bond, they issue at a cheaper level to the secondary market that are in the indices to get the bonds away. It's called a new issue premium. So if you buy it when it's issued, the indices don't include it in the index to the end of the month. And so you earn that new issue premium. As I said, you kind of got an array of bonds to choose from just from single individual entities. And then over time, very large parts of the universe are owned by non-economic investors. And when I say that, less price-sensitive investors. So think about central banks owning huge parts of the bond market through QE programs. They're very price-insensitive. Big global insurance firms own bonds to kind of back their liabilities at different points in yield curves. So it's easier to outperform on a kind of competitive game when half your universe isn't competing. And so that's a big part of it as well. And then there's big areas of the market that just don't find their way into traditional indices. So things like structured credit or securitized residential mortgage-backed securities, for example, don't find their way into traditional benchmarks, but you can still own them in funds. And so I think there's very sort of key structural reasons for why you see that persistence in the data, and I don't think any of those structural reasons are going away.
So just to follow up on that outperformance of active management in fixed income, like what do the numbers tell us? Like, is it how big is the outperformance?
All the research I've shown with kind of independent data, I think the most recent research I saw was just from Morningstar data from the huge universe of funds that Morningstar follow. It's statistically significant. It's not kind of, it's this persistence of outperformance after fees that you just can't see in equity markets. Most active bond managers kind of target maybe a percent over their respective benchmarks before fees and then minus fees, and you get left with the after fee return. But I can't remember the exact numbers, but it's definitely statistically significant. Yeah.
So, Adam, there's a real perception that bonds are just for retirees, or that you need, a fair chunk of cash to actually get access to a large part of the market. Is that the case these days? And how should we as retail investors be thinking about bonds and getting access?
Yeah, it's a great question. I think maybe that might have been the case 20 years ago. And I think the perception comes from individual bonds. Often, to trade them and clear them in the financial markets have minimum sizes. It's sometimes up to $500,000, which for the average retail person or the average person in general, it just puts it out of reach. And particularly not just owning one bond, but trying to own a diverse set of bonds with other asset classes as well. It's just not feasible. But over the last few decades, there's an array of passive and active mutual funds that are available. So not as easy as trading something on exchange, but certainly fill some forms out, and most of those have much lower minimum investment parcels. But more recently, particularly in the local market, there's been a huge development in ETFs, active ETFs, passive ETFs. So new development in the local market, which is fantastic. We've been managing active ETFs since, I think, 2008 at Pimco globally, but in the local market more recently with the development. So it's very, bonds are now a very accessible asset class for retail investors.
Yeah, we love that accessibility. I mean, it's why we're speaking to more fixed income managers, because we, for the first time, can access a lot of these products. Yeah. But the perception, I imagine, still exists. I imagine when you're speaking to particularly people in that accumulation phase of their wealth building journey, they might think that bonds aren't for them. Yeah. So make the case for people. Bryce and I like to think we're still young. Make the case that young people should be considering fixed income.
Look, I think as a point, younger investors. Investment theory shows a younger investment should have a bigger skew to growth assets. It doesn't mean you should have it 100%, particularly if you're trying to generate some income off your assets as well. But younger investors generally have a bigger skew of growth assets. Fixed income sits in that defensive part of the pie. But all investors should have an allocation to bonds, and through time that allocation should grow as you want less volatility and you're relying on more income. And so bonds sit neatly within that broader investment portfolio. So you should be thinking about bonds for income. You should be thinking about bonds for diversity. They tend to do really well when the riskier parts of your portfolio don't do as well. And as you said before, they're much more accessible now. I think if I step back, and I think why bonds now, the accessibility thing, but if I step back and have a look at asset classes around the world coming out of COVID, most asset classes I think are looking expensive, particularly relative to their own history or relative to other options. I think bonds are probably the only asset class that looks cheap relative to its history. We've had a generational reset in interest rates, and I don't think that's disappearing anytime soon. And so, if I look across the world at different asset classes and options, bonds look cheap when most of the universe looks fairly expensive. So I think bonds should be a part of all portfolios, and given starting point evaluations, bonds should be a bigger part of whatever that portion is, a bigger part than you would usually own. Yeah.
Should we be thinking about these ETFs that are coming to market and the ones that Pimco are bringing as well as bottom draw, set and forget, and just revisit it in 10 years, or are they more of a thematic we should be paying attention and not necessarily timing when we purchase them, but being more aware of what's going on in the market?
Yeah, certainly. I don't think set and forget sounds too passive to me, and particularly people listening to this podcast, I can't imagine a passive investor. They're very actively engaged in what they're doing. So I certainly wouldn't consider them as set and forget. But what I would think of them in terms of the suite of sort of core bond funds. So whether I'm just thinking daily, liquid, active, investment grade bond funds. So I wouldn't think of it as set and forget, but I would look at them at the moment as a very opportune time, if you haven't been involved in the bond market, to start having a look at this asset class. We've had a lot of volatility in interest rates, but we're at very high levels. If you kind of stand back from the noise of the recent few years, at least 10-year bond yields, government bond yields, haven't actually moved that far. They've been kind of in a range, but haven't moved that far. We've had a big kind of steepening in yield curves, so front-end rates or short-term rates are coming down as central banks lower policy rates, and longer-term maturity bonds yields have gone up because we've seen a lot of fiscal expansion and bond supply from governments around the world. Bonds in general perform really good in that environment. So if you look at the last 12 months, I would say most core bond funds have had kind of high single-digit returns. And I think that's the kind of environment of higher interest rates, steeper curves and volatility that we're in for the next couple of years. So certainly if you haven't looked at this asset class now, before, this is a perfect time to have a look.
Now's the time.
We've got a couple of questions on the market environment, the rate settings, fiscal expansion that you mentioned earlier, coming up a bit later. But I want to hold on how Aussies can build fixed income into their portfolios now, because I think it's an important conversation to have in full. And I think one thing that always surprises me is the huge amount of cash Aussies are sitting on and what they're doing with it, or what they're perhaps not doing with it, and the ongoing love of an Australian term deposit. We love locking our money away, I guess. So talk to us about how we should be comparing fixed income opportunities to term deposit opportunities. What's some of the opportunity cost, I guess? And I think part of the attraction for Australians is the consistency of income from TDs.
Yeah.
How do bond ETFs compare?
Yeah, great questions. I think there's always a role for cash and TDs in broader portfolios. I think a couple of things are different. I would caution, people thinking about TDs as kind of defensive dry powder. When I think of defensive dry powder, I think of an asset that's going to do well when the riskier parts of my portfolio aren't going to do well. I think that is defensive. And I think of things that are daily liquid I can kind of sell and buy. So if the equity market does tumble, I don't have anything locked in for 6-12 months, I can actually use my cash to go and buy it. So that's the way I would think about bonds. The risk of term deposits, particularly as particularly in the investment or business cycle we're in now, is cash rates are coming down. Investors should be preparing their portfolios for that every quarter. For TDs, while they're extremely safe and provide consistent income, the risk is you're just resetting that at lower and lower interest rates every quarter from here. So the asset doesn't go up and your income goes down over time. I think the opportunity that investors have for this portion of their portfolios, is the exact opposite to the opportunity we had during COVID with our mortgages. Interest rates are really low and near zero. We could all lock in our debt at low interest rates for 3 to 5 years. It's the flip side now. Interest rates are high, likely to come down, keep coming down. We have an opportunity to lock in interest rates on our savings, which is stepping out beyond savings accounts and TDs to bond funds. So I think that's the way investors need to think about the asset class in that context, relative to TDs, which I said always have a place, but in this environment, the risk is you're just kind of resetting at lower income levels rather than kind of locking in higher interest rates.
So can you put some numbers to it, like the savings accounts these days, what you can get 4.5%, 5%, thereabouts, maybe a little longer if you lock it in a TD. If we were to look at an active bond ETF, like what sort of return should we be expecting?
Yeah, I think if you look at back through history, the best predictor of kind of longer term returns on bond funds is a starting yield. If you look at a starting yield, I think it's got about a 93% correlation to your average 5-year return. So that it does move up and down, and it's volatile through time. But I think conceptually the way you think about that, if I bought a 5-year bond and closed my eyes in 5 years' time, I would have earned the yield as long as I got my money back. Bond funds, have everything from a date of maturity out to 30 years, but on average they've got an interest rate duration around 5 years. So it's still a very high correlation between your starting yield and your average 5-year return. I think most active bond funds probably have at core bond funds like global investment grade, either in Australia or global hedge to Aussie dollars, have interest rates or yields kind of between 5 and 6% at the moment. So for longer term investors, in thinking kind of out 5 years, what would my average return be? It's a good reference point. Now that can move depending on what interest rates do through the time. So every month and quarter and year, it's not going to be that number. It's going to be something else. But it's a good reference point, I think, for longer term investors thinking out 5 years. So what could move that around? I think that's the important thing to think. Thinking through scenarios where the world isn't stable. So if interest rates, say we're wrong and central banks aren't lowering, policy rates, and interest rates around the world go up 1%. Your interest rate risk on your average bond fund is usually around 5 years. Which means you probably have through that time a temporary 5% capital loss. So if you've got a starting yield of 5-6% and you get a 5% capital loss, your average return's kind of positive 1%, close to flat. Call it close to flat. So that's kind of your downside. But on the other side, if which I think is more realistic, and risks are skewed the other direction, that interest rates come down a little lower than what we're expecting. Then you're adding the potential for capital gain to that starting 5 to 6%. So a good example of that is the last 12 months where bond returns were kind of in the high single digits. So I think that's a reasonable kind of range to think about. So long term, starting yields are kind of 5 to 6%. If you close your eyes and open them in 5 years' time, you're probably going to be somewhere near that number. And kind of over shorter periods, the bigger driver will be interest rates, and I think they're kind of reasonable kind of ranges of what you'd expect on total returns.
So as we close out this section talking about how these ETFs can fit in Aussie's portfolio, I just want you to bust some jargon for us, because Pimco have a range of active ETFs listed in Australia, and I think this is terminology that's reflected throughout the industry, particularly investors that are new or have mainly been focused on equities. They may not understand the nuances. So you've got Australian bonds and global bonds, and then you've got global credit, and then diversified fixed income.
Yeah.
So just separate those three: bonds, credit, fixed income, or diversified fixed income, and just explain how Aussie investors should think about each of them differently.
Yeah, good question. So I'll start with the Aussie version. So that's just predominantly Aussie dollar denominated bonds, investment grade. So Commonwealth government, think of the Australian state governments, and then investment grade corporates and some structured credit. But think of that as like the main kind of driver of return volatility is going to be Aussie interest rates for that one, but a high quality investment grade portfolio. Then the global bond version is the same thing, but globally. So global sovereigns, global corporates, all investment grade. Global interest rates will be the main driver of return volatility, and all hedged back to Aussie. So none of these portfolios have a lot of currency risk. They can take some active currency risk, but vast majority is just hedged to Aussie dollars.
And just another jargon buster, investment grade, what rating is that?
So
and above?
triple B minus and higher.
Okay. And to put that into context of like a Australian company or organisation that would be around that?
So some of the retail investment grade corporates, think like think Woolworths and those types of names.
So big Aussie blue chip companies.
Big Aussie blue chips. Your Telstras are probably in the A category. Aussie major banks are in the AA category, AA minus. So, but you're thinking kind of big Aussie blue chips or regulated utilities or essential infrastructure. So triple B names are often airports, toll roads, things like that. Yeah. And so kind of most of the names you'd be very familiar with, and if you weren't familiar with the names, you'd be familiar with the infrastructure and assets kind of thing. Yeah. So that's it on the Aussie dollar version. Yep. So the Aussie bond version. The global bond version is just a global version of that. So kind of, I think, of much more diversity in terms of what it holds. Biggest driver of return volatility would be global interest rates, but a mix of kind of sovereign and corporate and structured credit, but investment grade predominantly. Our diversified version is just a 50-50 combination of those two funds.
Of the global bond.
That's right. So we have some clients that come to us and say, Aussie bonds going to do better than global bonds, and how am I meant to actively manage between the two? And we say, don't worry, we'll do it. Just buy the diversified version. So it's like a 50-50 combination of those two. And then the global investment grade, think of that one as largely like the global fund, but stripping out the sovereigns. So if you're taking a bit more credit risk, earning a little bit more yield, but sort of global investment grade corporates without the sovereigns. Think of it that way. Yeah.
So, Adam, given that so much of your time is spent understanding what's going on at a macro level, it'd be a missed opportunity if we didn't get your thoughts on where rates are going.
Yeah.
I mean, Aussies spend most of their time thinking about property. Second is interest rates.
Well, I mean, they think about interest rates because of property.
Exactly. Mortgage rates.
And fixed income, but a lot of property.
It's probably the first question I get at most panels I'm on is where's my mortgage rate going?
Whoa, where's our mortgage rates going?
That's like the shiny thing that you get people in the room for, and then you sell them on bonds when they're in the room.
Exactly.
So I guess what's keeping you up at night, or are we overestimating what's going on at a macro level in terms of where the rates are going to go, both here locally and over in the US?
Yeah, look, I don't think so. I think what we're seeing at the moment is economies kind of getting back towards equilibrium. We had this massive shock through COVID. Then coming out of COVID, we had kind of supply chain disruptions and kind of a big demand release because everyone was locked in their houses and could finally get out and spend money, and interest rates rocketed up, inflation's rocketed up. I think we're kind of moving away from that, and economies are getting their way back to equilibrium. And so what I mean by that, I mean, we think growth will be sluggish but improving. Inflation's pretty much back to central bank targets around most parts of the developed world, which means interest rates should be closer to neutral rather than restrictive. So in Australia, interest rates were really restrictive coming out of COVID. I know optically we looked at a kind of a 4-point-something% cash rate versus a 5-point-something% cash rate elsewhere, and thought we might have been less restrictive. But we kind of went through 12, 18 months while interest rates are at that level with no real growth in household spending or business investment, no real growth in anything except public or government spending. So it was very restrictive, particularly for households. And I think we're kind of on a path now where interest rates are coming back to neutral. And for Australia, we think that is a cash rate of somewhere between 2.5% and 3%.
Wow.
So we're at the moment, I think there's no signs flashing that they need to kind of get there really quickly. And so I think cutting at a quarterly pace back to somewhere between 2.5% and 3% as we get into next year is a reasonable kind of base case. I spend most of my time talking to clients about interest rates because they stress so much about interest rates. As a bond manager, it never keeps me up at night. I worry about not getting my money back. At the end of the day, I get some interest rate volatility, but I do really poorly if I give someone $100 and I don't get it back. So defaults is what keeps me up at night. In Australia, we have come through a pretty soft macro environment. As I said, growth hasn't been particularly strong, and I think we're coming through a period where the riskier end of corporate lending is struggling. We're seeing kind of defaults and restructurings. In Australia, we don't have a public high yield market, a high yield being a sub-investment grade market like we do globally. So most of that high risk lending kind of sits in the private markets. That's something that's high up on our list, just watching how that evolves over the next 12, 18 months. Just whether that stress at the risky end of corporate markets starts to broaden out. So we're certainly less worried about interest rates and making sure our portfolios are much higher quality and up the capital structure, so that they can kind of be resilient if we end up in this macro environment that's a lot more challenging for a longer period of time than we expect.
I mean, if we get down to that 2.5%, it's good news for mortgage holders. That is for sure.
2.5 to 3. There was a range. I know.
The
mortgage holder immediately. Mortgage holder sees the 2.5.
Banking it. What about the US though? We hear that Trump wants to cut interest rates by up to 1%. He thinks it should be a lot lower.
Yeah.
What are your views on what actually is playing out?
Taking the politics away for a moment, not too dissimilar to Australia, when the inflation's coming back to target, we've got it'll be temporarily higher in the US than it is in Australia as they kind of navigate this tariff bump as they kind of importing inflation for a couple of quarters as the market adjusts to the tariffs. But as we get into that, it's 2026, we do think inflation comes back to target, and it's a central bank that needs to get somewhere back to neutral as well. So neutral's there is probably a little higher than Australia, probably around 3 rather than below 3. I think as we get into start navigating through 2026, that's where we'll end up. Somewhere close to 3%. There's a whole range of risk scenarios around that, whether or not you end up getting a Fed that wants rates a lot lower, or you certainly have a president that wants rates a lot lower. But at least in our kind of baseline expectation, you have an institution that is setting monetary policy based on macro conditions that they're facing, and policy should be somewhere close to neutral, around 3%. Yeah.
So you said that the thing that keeps you up at night is bankruptcy, not getting your money back when you lend it out to companies or to sovereigns.
Yeah.
It felt like when the Liberation Day tariffs first came about, there was a bunch of chat around, companies struggling, empty shelves. As far as I can tell, we haven't really seen like a rise in bankruptcies in the US, but you're obviously closer to this story than we are.
Yeah.
What are you seeing in the US around that risk of bankruptcies and not getting your money back?
Yeah, it's very different depending which part of the market you look at. So if we go back to kind of April when the tariffs were originally announced in their first form, we put ourselves in the same camp. We were quite worried about recession risks and how the world was going to navigate that. Fast forward to now, tariffs are high, not quite as high as were feared originally, but still very high. And so it's not going to be an easy macro environment for the next 12 to 18 months. If you look at in the US, investment grade corporates, so the large investment grade corporates have very strong balance sheets. Not too dissimilar to Aussie mortgage holders. When rates are really low, they termed out their debt, sometimes out 20 years at very low interest rates. So the pass-through of higher interest rates onto their income statements and balance sheets has been really slow. Can't say the case for more highly levered sub-investment grade borrowers in the corporate market in the US that weren't able to term out their debt, that the higher interest rates have passed through rapidly. And so you are seeing instances of, particularly in the kind of leveraged loan market, where borrowers are struggling and kind of getting behind on their interest payments, or what we call picking and payment in kind, where the interest rates just capitalise on the debt rather than paying it. So we're certainly seeing stress in pockets of the highly leveraged corporate market in the US, but certainly across the economy as a whole, still looks reasonably healthy. Yeah.
So we speak a lot about Australia, obviously, because that's the context that we're speaking in, and the US because the world looks to the US, and US financial markets seem to set the tone for the rest of the world. Are there any other financial markets, particularly when it comes to this interest rate conversation, that you think we should pay attention to more?
So I think fixed income is, as I said, a massive global market. So the Aussie market, is large, vibrant, and growing. And the US market kind of dominates like equities in terms of its size. But every kind of developed market has a very large fixed income market. So when we look across the opportunity sets in our funds that take global exposures to bond markets, we do have a big allocation to Australia. We think interest rates here look really attractive. There's certain areas of our market that are very high quality and often even offering even higher kind of spreads on top of kind of riskless government rates, whether that's our state governments, whether that's a AAA residential mortgage in Australia. That market, most people don't realise, but in Australia we've seen kind of the traditional banks step back from their areas of traditional lending, whether that's in auto lending, certain areas of residential lending. So we've seen this huge growth in non-bank lenders. You probably see, you go to any kind of mortgage broker and you'll see a run of 30 different lenders these days that can lend you money. All of those lenders don't have deposits, they're non-bank, so they need to get financing from somewhere to make those loans, and they come to the bond market. So most people don't realise that outside the US in the last kind of 12, 18 months, Australia's been the largest public securitised bond market in the planet in terms of new issuance.
Yeah, right.
So there's been huge opportunities there for bond managers to kind of step in and fill that financing role to that sector that's grown. And then there's other parts of the world, in the developed world, where interest rates are still much higher than we think are neutral, and they do need to get back to neutral. One of those I'd highlight is the UK, where interest rates are still materially higher than Australia and the US, and kind of what we expect to come back to neutral over the next 12, 18 months as well. Heaps of opportunities locally, and a lot of diversity, kind of diversifying opportunities globally as well.
Well, Adam, to close out for everyone listening, if there's one thing that you would like them to think about or consider or remember, what would that be?
I think I'd go back to my point on valuations. If you haven't looked at this asset class before, I think we're in a world where most asset classes look expensive relative to their own history, with the exception probably being core bonds. We've had a generational reset higher in interest rates. We've got local investors who are looking for other alternative income sources, with a hybrid market being phased out. There was previously like an accessible, tradable income generating market. And so if you haven't looked at this asset class before, you're seeing one of the best opportunities to get involved, I think, in the last 10 to 15 years. So certainly consider it.
Nice.
Love that.
Well, Adam, we joked at the start that this was Equity Mates, and we're traditionally a share market podcast, but I think we started this 8 years ago, and it was a function of what was accessible to us at the time.
Yeah.
So I think we love the fact that more and more funds like yours are coming to market. This asset class is becoming more accessible, and I'm sure this won't be the last conversation we have about it, because it's a whole new world for us to learn about. So thank you for coming on and helping us learn.
No problem at all. Thanks for having me.
Thanks, Adam.
Thank you.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.